Now, the two that are involved in the present situation index include assessment of business conditions, labor market conditions. On the expectation side, it's the outlook for business conditions, the outlook for labor market conditions, and then related, the outlook for income prospects. Welcome back to the 𝗪𝗚𝗙𝗀𝗀 Daily Podcast of the Day. Thank you, Apes, for joining us here once again on the world's single most powerful and influential news organization here at the 𝗪𝗚𝗙. We greatly appreciate having you with us. Today is currently Tuesday, September 24th, 2024. It is 6:04 p.m. and we have a lot to talk about today. It was a big day in markets, despite the fact that there wasn't any major economic news that was driving the movements of the day. There was some stuff, of course, we'll talk about it briefly here. But overall, a lot of kind of under the surface volatility. It was a stock picker's day, to say the absolute least. If you look at one of those market map things that they have on finviz.com or one of those others, you'll see that there's really no rhyme or reason driving those colors. It's very much an idiosyncratic performance day. So shout out to all of you stock pickers out there. I hope you guys were making your bread on the session. Now, if you were holding the S&P 500, you certainly were. The S&P 500 index was up 25 basis points on this session. NASDAQ much higher at 56 basis points, thanks to a huge rise from NVIDIA that we'll explain for you in just a quick second. That is one of our big stock movers of the day. Less strong day on the small cap side, but the Russell 2000 up 17 basis points, and the Dow, not that anybody cares, was up 20 basis points on the session. All of them put on an absolute clinic compared to the WSO Alpha portfolio, which only rose a measly little 4 basis points. That brings our year-to-date return to 13.7%, which I am completely embarrassed to say out loud, but nonetheless, those are the facts. And if we're anything here at the 𝗪𝗚𝗙 besides the most powerful and influential news organization in the entire world, we are transparent. So I'll always keep you guys updated on that front. Now, keeping you guys updated on some other stuff, home prices recently set a new record high. And now we're talking about the S&P Case-Shiller index here, which is the bane of my existence and the bane of the housing market's existence, to be honest with you. Home prices set a new high, allegedly, but they're talking about all the way back in July. So who knows if this is even still true, but they did appreciate at a slower rate in that month than they have been throughout 2023 and 24. So, starting to chill out a little bit, it seems like, which is always beneficial for home buyers. Obviously, as soon as I have a home price acceleration starts to slow down. So that's just Uncle Sam and the economic gods working together to double team me here, I guess. Either way, hedge funds are also seriously repositioning or kind of rethinking their positioning going into the final quarter of this year. They are rotating the hell out of consumer stocks, exiting discretionaries and staples. Now, they've been exiting discretionaries for quite some time, but this was the 6th straight week of exits from the consumer staples sector as well. So getting a little bit bearish on the consumer. Meanwhile, Sherwood News keep killing it out there, but they just published a very good summary on China's new stimulus announcement. Some of them are a little bit more creative than you would expect, and we'll talk about that pretty soon as well. China stocks are one of our big stock movers of the day, so if you want to understand the new announcement that they just made, make sure to stick around for that portion. Novo Nordisk, just a day after we dive into how the Danish economy is entirely dependent on Novo Nordisk for all of its growth and job creation, the CEO of Novo Nordisk was just absolutely grilled on the Senate floor. I don't know why this guy would even agree to come to a meeting in the U.S. Senate. He's not really, if he wants to sell products in the United States, I guess he's regulated by the FDA. But still, you would think that he could just be like, fuck off, I really don't care. Either way, he was a good sport, showed up to get absolutely roasted for Ozempic prices allegedly ripping off consumers. They're trying to rip off fat off of these consumers. So, I feel like a higher price might not be the worst thing in the entire world, but still, nonetheless, that's what they're seeing. So could be a worrying sign for the Danish economy. An even more worrying sign for Caroline Ellison happened yesterday. However, Caroline Ellison, many of you will remember, you old vets of the 𝗪𝗚𝗙, you veteran apes out there will remember Caroline Ellison. This is the former girlfriend of scumbag fraud, aka Sam Bankman-Fried, the Bernie Madoff of the cryptocurrency world. So Caroline Ellison was SBF's ex-girlfriend, also the CEO of Alameda Research, which was the fraudulent trading company that paired up with FTX. She just got sentenced, and even though she turned on her ex-lover and testified against him in open court, she just got hit with a 2-year prison sentence, which is absolutely correct because she participated in creating a fraudulent balance sheet. So fuck her. She's, I was going to say, Hope she enjoys that for the rest of her life. But 2 years, really not that bad. Maybe some time to reset. Maybe plan out a different career path, because that seems like something that she'll need when she comes out the other side. Finally, Blackstone and Vista Equity Partners are officially taking Smartsheet public for $8.4 billion, unless a newer, better offer comes in. But, I'll be fucking damned if that actually happens. All right. Moving into our big story of the day, we have Macro Monkey today. We are talking about bipolar consumers. Really, probably should have called this confused consumers, but it's just showing completely opposite ends of the spectrum across different sentiment readings. So, economic problems in the United States are rising almost as fast as mental health disorders. So we'll go ahead and call these economic health disorders. They were on full display on Tuesday. The Conference Board published its latest sentiment reading, measuring consumer sentiment, expectations, assessments of current conditions, and everything else like that. But the data that they release is in direct contradiction to one that we got earlier this month on the University of Michigan survey. This is all pertinent to the month of September, so let's talk about why consumers are getting bipolar heading into the fall. So what did they release here? The conference board just came out with their consumer confidence index for September. Now, obviously, we're not done with the month of September. This stuff goes to the 17th of the month. They're kind of taking 2/3 and then, expediting the rest of the month based on that 2/3 kind of analysis. But either way, they came out here and they published their consumer confidence index. Now, the consumer confidence index basically has 5 subcomponents that they're looking at. Those 5 subcomponents are organized into 2 different indices. One indices is the present situation index, and that incorporates just 2 of the subcomponents, whereas the expectations index incorporates 3 others. Now, the 2 that are involved in the present situation index include assessment of business conditions, labor market conditions. On the expectation side, it's the outlook for business conditions, the outlook for labor market conditions, and then related, the outlook for income prospects. And all of those outlooks are over the next 6 months. So the overall index, consumer confidence index, this is the broad that takes into consideration all 5 of those subcomponents, declined a very not so nice 6.9 percentage points. Usually we're celebrating when we see a 6.9, but unfortunately that wasn't the case here because it brought the total index under the 100 level down to 98.7. Within this index, if you're above 100, that means vibes are more good than they are bad. And if you're below 100, vibes are more bad than they are good. So we just fell below 100 for the first time in quite a while. Definitely not a strong sign for the economy. Now, if we start to scroll down and kind of dive into the data a little bit, we can see that the present situation index fell like it was fucking Joe Biden getting onto a plane or something. Just completely tripped and fell off its face, falling 10.3 points, sitting at a 124.3 level. So overall, consumers' assessment of the present situation is still very positive, but it is rapidly deteriorating. That was the furthest drop that we've seen since at least August of 2021. The expectations index, meanwhile, is on very thin ice. Whereas the present situation index is at 124.3 and falling very fast, the expectations index is basically the exact opposite. So like we said, 100 is the line that you want to think about. Above that, you're good. Below that, you're not very good. Now, within this index, if you're 80 is another key line that you're at. So if you're below 80, there's almost definitely a recession on the horizon. The expectations index fell 4.6 points in September to 81.7. So just above that line that signals a flashing sign of a recession. But hey, if the inverted yield curve didn't actually point to a recession, then I don't know if this consumer data is going to. But nonetheless, things weren't looking too good on the expectation side either. Now, if we break down each one of these subcomponents, like we said, there's 5 subcomponents. If you break them down, the questions are basically, is this good or bad? So business conditions. Are business conditions right now good or are they bad? Is the labor, are jobs plentiful or are they hard to get? No, that's kind of the basic idea. So within these 5 subcomponents, there's basically 10 categories that you can look at, and it's just the positive or the negative side of either one. Every single one of these deteriorated. All 10 of them deteriorated except for one measly little increase. That one measly little increase was a 0.1% increase in the percentage of respondents saying that jobs will be more available 6 months down the line. But that was completely offset by a 1.3% increase in those saying jobs will be less available 6 months down the line. So really, no positivity to be looking at from this report whatsoever. Now, if we break things down a little bit, the biggest deterioration was in the present situation of current business conditions. Those responding that conditions are currently bad increased 2.9% for the month. That was followed by a rapid decline in the amount of people saying that business conditions are good, down 2.3%. Then next up was that business conditions will worsen, that increased 2.1%. And they expect incomes to decrease 2.00%. So the way that this all kind of works together, you start to think about, current business conditions, and that's going to impact what you think about labor market availability going forward. If business conditions are good, there's going to be more hiring, more prospects for economic growth. If labor conditions are good, then, incomes will probably rise up a little bit. That last subcomponent being the expectations for incomes to increase or decrease into the future. So each of these kind of builds on top of each other. They lead into the next one, depending on which direction you want to look at it from. So the deterioration in business conditions and expected deterioration in labor market conditions going forward all kind of aggregated into a heavy demotivation, demoralization, and expected income 6 months down the line. So what we saw was a 2% increase in those that expect their incomes to decrease over the next 6 months. Find a new fucking job if your income is going to decrease. Holy shit. Meanwhile, the amount of people expecting their incomes to increase over the next 6 months declined to 60 basis points. So overall, everybody's expecting their financial conditions to get worse going forward, at least according to the Conference Board. Now, this is where things get interesting because, as reported last week, the University of Michigan reports that current consumer sentiment, assessment of current conditions, and expectations all increased on a monthly basis in September. Sentiment was up 1.6%, current conditions were up 2.6%, and expectations were up 1.2% from the period from August into September. Now, on an annual basis, we did see an 11.5% decline in current conditions, but we also saw an 11.1% increase in consumer expectations going forward, and a 1.8% increase in consumer sentiment overall. So, the methodologies that these organizations use are very similar. They're just calling out and asking questions. Now, the wording of those questions can very much drive different results. Maybe that could be a reason for it, but I think consumers are overall just confused, don't really know what's going on, and everybody makes their economic assessment, especially about their expectations of the future, at this point is entirely dependent on the presidential race because we can't get our heads out of the fucking gutter, even though politics has absolutely, very, very little to actually do with tangible results from the economy and the stock market overall. But hey, as the old saying goes, if you're not at least a little confused, you're not paying attention. Well, consumers are incredibly confused, so that must mean that they are paying a ton of attention. We're very glad to see it. Let's go ahead and move into some stock movers. So, beginning with our stock movers that headed in the right direction yesterday, we first and foremost have Chinese stocks. Now, the asset that I'm going to use to measure Chinese stocks here today is called KWEB, ticker symbol KWEB, up 10.32%. This is the Crane Shares China Internet ETF. This was one of the first purchases that I ever made when I started investing back in 2018, by the way, so this is kind of a blast from the past for me. Either way, bad news has officially become good news when linking the Chinese economy to the stock market. It's in a similar position that the United States was in 2020, 2021. Further deterioration in the economy means increased stimulus, and that is exactly what we are seeing out of China. So, yesterday, long duration names absolutely popped because there was a decline in the interest rate despite the fact that it was relatively off cycle. Yesterday, our macro monkey of the day yesterday was talking about how fuck China is and how weird it was that the central bank didn't do anything at the regularly scheduled meeting the week prior in order to kind of combat the challenges that we were describing. So they clearly must have listened to our live stream or something and came out there and basically said, all right, you know what, maybe David's right, maybe we should enact some more stimulus, and that is exactly what they did in the overnight session. Some of the biggest things that they did were they cut mortgage rates on outstanding borrowing by 50 basis points, they lowered the minimum down payment on second homes from 25% to 15%, they reduced the reserve requirement ratio, meaning banks don't have to keep as much money at the People's Bank of China as they had to before, encouraging further lending. They trimmed their 7-day reverse repurchase rate by 20 basis points to 1.5%, and there is 800 billion yuan, or about $70 billion in quote-unquote liquidity support for the Chinese stock market. Now, what does that mean? Basically, the People's Bank of China is directly lending $7 billion to funds, brokers, and insurers to go out and buy Chinese stocks. They're giving you assets to say, go out and buy these things. They want to, create enough aggregate demand that's going to lift the entire market so that these loans actually pay off. Very Chinese things to do. You would never see these stimulatory measures taken in the United States because we're not literally communist. But, that's one of the advantages of being a totalitarian techno-state that China is. Alibaba was up 7.88%. Now we had NIO up 11.55% and JD.com up 13.91%. Basically, the longer the duration the stock was, the better they did on the day. All right, moving into our next big mover. This is a company some of you might be familiar with. Ever heard of NVIDIA? Well, I'm sure you missed out on the run-up just like most investors did, but the stock was up another 3.97% yesterday, so if you happen to buy at the open, congratulations, because you are part of the team that is becoming rich from NVIDIA. We knew that this was a very unique stock. You know, it's not often that you see going from obscurity to the literal largest company in the world in about a 1.5 year long period, and that's exactly what this company did. Throughout that period, CEO Jensen Huang has been selling shares, and that really ramped up in 2024. So, CEO Jensen Huang, he just wrapped up his share sale that was enacted in March 2023. Taking a step back, basically, the CEOs do this a lot. They come out with, or really directors, insiders of companies do this a lot. They come up with, plans, like predetermined plans of when they're going to sell shares so that when they start dumping, it's not actually a surprise for the market. So that's exactly what Huang did in March of 2023. There was a 2-year plan for him to sell X amount of total shares, and he just completed that as of September of this year. In 2024 alone, this guy pulled out $713 million out of his holdings, and that's on top of $110 million in 2023. That's roughly $823 million in total sold from NVIDIA. Now, this is direct cash that he's getting from selling. Obviously, he can still lend against his shares. They're worth about $104 billion even after these sales. He owns roughly 861.4 million shares in the company. Now, the reason that I think this is relatively bearish is because obviously if you're a CEO and you say, I'm going to sell all these shares over the course of a 2-year period, you'd probably want to do it on a relatively regular basis and then finish at the end of that period, because otherwise what he's done now is basically by kind of like rushing to complete the sale before the end of the predetermined period in March of 2025, kind of implicitly he's saying, like, I'm going to sell right now while the stock is high. It's kind of like, if you're trying to get out of your holdings right now, can we expect the stock to fall between now and when the end of your actual selling period was? What is going on here, Jensen? He's probably busy out there signing somebody's boobs like he did at his company's investor meeting. So we'll see if, any of this actually matters or if the stock responds to it. But investors were hyped up that he's not going to be selling anymore. But if we kind of read between the lines a little bit, it's not exactly as bullish as the market seems to have thought it was on Tuesday. Market definitely didn't think that news coming out of Visa was bullish on the day, though. Moving into our stinky, rotten movers of the day, we have Visa down 5.49% on the session because the Department of Justice is out for blood. Lately, this agency, the Justice Department, the DOJ, if you will, has been on a murderous, lethal streak worse than that of the fucking Zodiac killer, coming after these giant companies with antitrust concerns. Absolutely wasting no time between opening a huge case against Google. The Justice Department went ahead and opened a new case against Visa, alleging that the company has an illegal monopoly on the U.S. debit card market in a way that penalizes customers that are trying to use alternative payment processors. Analysts weren't really surprised by this, especially ones over at Citi, and especially Mr. Andrew Schmidt. Shout out to you if you're watching this. Andrew Schmidt over at Citi maintains a buy rating, but switched the firm's sector preference from Visa to MasterCard out of concern over, quote, incremental regulatory overhang for V. That's one of the smartest stretches of words that I've ever heard personally. But either way, shares down 5.49% on antitrust concerns. Finally, we have Starbucks down 1.08% on the session. Absolutely impossible to believe that Starbucks shares are down now that we're in the fall and everybody and their mother is going out and buying pumpkin spice lattes or whatever the fuck fake-ass coffee drinks you people are drinking out there. I'm a black coffee man through and through. Personally, would never drink anything else because that is a fucking milkshake. But either way, Jefferies came out and downgraded shares in Starbucks today, basically saying that the pop that shares received from hiring their new CEO, Brian Niccol, is a sell the news moment. They said specifically to sell the pop moment for Starbucks shares because there's going to be a hell of a lot more work to do to get this company back on track where it used to be before kind of falling off the rails throughout the course of 2022 and into 2023. All right, Jesus Christ, let's go ahead. One more story to talk about here today. Our thought banana is nuclear going nuclear. Now, if you didn't believe me when I said that the Daily Peel is the most powerful and influential media organization in the entire world, maybe this will finally convince you. Not even, or barely more than a month after we published a piece in our Thought Banana section begging, pleading with leaders of the world to invest in nuclear energy and start to proliferate energy generation from nuclear power sources. Turns out they're actually starting to listen. So on Monday was the start of this year's New York Climate Week, which is one of those kind of bullshitty conferences that they do to make sure Greta Thunberg doesn't come fucking crying at everybody's doorstep again. it's one of those things that they go and everybody kind of like holds hands and cheers about how we're going to save the world, but usually nothing actually gets done. And when I say nothing actually gets done, I mean the organizations that are making commitments for the climate include countries, NGOs, nobody that has any actual, financial power to be able to affect these changes or enact these changes that everybody's looking for. So, what happened on Monday was huge because 14 of the world's largest financial institutions made commitments to invest in short and long-term expansion of nuclear power generation with the goal of tripling nuclear output by 2050. Now, this is something that a lot of countries had did at the end of 2023, but again, how is a country going to do it without a bank in order to lend to them? And now, you could say, David, they'll just have their treasury departments do it. They'll have their central banks do it. Are central banks in the industry of making loans for infrastructure projects? Not the last time that I checked. They'll kind of fund banks to go ahead and do that kind of stuff. But when you have Goldman Sachs, Bank of America, Ares Management, Barclays, a whole bunch of other of these banks and non-banks coming together and saying, we got to get this shit done, then we can start to have some belief that it might actually come true. So that's why we're getting particularly hopeful, because these banks committed a huge amount of money in order to do so, undisclosed amount, but still there's estimates that it's like in the upwards of $10 trillion range. We definitely need to add that to the U.S. debt balance in total, so I'm glad that it's going from these banks. Now, according to Goldman Sachs, this is a research report that they published earlier this year, AI impacts could quintuple energy demand. Did you hear me? I said quintuple. That means 5x. Increase by 5 times global energy demand between 2020 and 2030 just from the advent of artificial intelligence. Clearly, that means that there's huge demand in the energy sector, and where there's huge demand, there's huge profit. So this is what's finally getting these banks involved. It's the actual profit motive. It's not just, all right, we need to make this transition and it's going to be super costly, and then you're also going to make basically the same amount of money that you make on fossil fuels right now. This is a huge profit opportunity for these banks, so there's actually a reason to get involved. And if you don't believe that there's a profit opportunity, Microsoft is already proving it. The artificial intelligence daddy and Sam Altman's, I'm pretty sure it's Sam Altman's biological father is Microsoft Corporation. Earlier this week, the tech giant announced, in partnership with Constellation Energy, a 20-year agreement to supply nuclear energy for Microsoft's artificial intelligence demand from 3 Mile Island. Now, the boomer apes out there especially might remember 3 Mile Island is a nuclear reactor that went kablooey in Pennsylvania. I actually have no idea when. I think it was a couple of decades ago. It was one portion of the reactor that went offline. I don't know it from an engineering perspective, but there's different portions of the reactor. I don't know what the right words are to use for them. Maybe it's different reactors within the power plant overall. Basically, the last one was shut down in 2019. No nuclear power plant has ever been put back online in the United States. Once their useful life is over, they don't get reinvested in and refired up at all. This is the first one that is going to, because Constellation Energy is now firing up 3 Mile Island once again in order to supply Microsoft's AI demands. Microsoft is paying a premium for per unit of energy on a unit economics basis within their power purchase agreement. Microsoft is paying a hefty premium over what they would for something like fossil fuels or even solar or wind in order to get this power plant back up and running. But apparently they seem to think that it's going to be worth it over the 20-year PPA period. So looks like there's something actually is going to happen here, because once again, banks have a profit motive and Microsoft has proven it for them right now. That is a fantastic segue into our quote of the day. Mr. Charlie Munger, the absolute GOAT, rest in peace, one of my favorite speakers, writers, investors of all time. He has a very famous quote where he said, "Show me the incentive and I'll show you the outcome." Now these banks have an incentive to invest in nuclear energy. They can actually make some money off of it. So they are smelling green just as much as artificial intelligence, or just as much as Microsoft is smelling green in artificial intelligence. We'll see if it all comes to fruition, of course. Only time will tell, but hopefully we'll be around here in the next 20 years anyway, so if we are, might as well be getting a lot more energy from nuclear. That about does it for us here today, apes. Thank you all for joining us here so much. It is now 6:27 p.m. I think I might go have some dinner. If anybody has some recommendations on what I should get for dinner tonight, please let me know. David at WallStreetOasis.com. Thoughtful emails will always get thoughtful responses. Love seeing you guys come across my inbox, by the way, so if anybody is still here watching this, you better send me an email. All right, that about does it for us today. I got nothing else to talk about. Happy investing, happy trading. Bye now.